Hello, and welcome to today's Sherpa Funds Technology Process Alpha webinar on how often should you rebalance your portfolio. Thank you if you're joining us here in Asia this morning. We did have a couple people registered for this session in the States, so more power to you if you're staying up late to check out our session. For anyone who misses the session today, if you come in late or if you have to jump off midway through, we will have the replay posted on our YouTube channel later today. Also, if you would like a copy of the slides, if you'd like presentation materials, feel free to reach out on email. Contact information is at the end of the session, and we'd be happy to pass that along as well. So my name's Stephen Quimby, head of sales and marketing here at Sherpa Funds Tech. I'm joined by our CEO and founder, Richard Waddington. Richard, give the people a good greeting.
Hello, good morning, good afternoon, good evening, everybody.
Great. And so today, again, if you haven't joined us for previous Sherpa webinars, our goal today is going to be around 30 minutes. We usually have a lot to get through, and so sometimes we bleed a little bit long, but the goal is to take about the first 25 or so minutes to actually go through the body of the presentation, and then to do 5-ish minutes of Q&A at the end. If we're a little long, a little short, that's the expectation. It'll take us about 30 minutes. We'll do Q&A at the end. If you have any questions midway through, by all means, feel free to ask them in the webinar chat, and we'll see if we can get to them midstream. If not, again, we'll certainly tackle it at the end. So with all that kind of housework out of the way, what we're going to talk about today is something that we actually talk about with a lot of folks, and it's let's say a blind spot, I think, for a lot of PMs. And this is thinking about rebalancing your portfolio. And so I think for most systematic or quant PMs, rebalancing is something that is second nature to them, and it's something they spend a lot of time thinking about. For more discretionary PMs, much less the case. But it's equally important whether you're a discretionary fundamental PM or whether you're a more systematic and quantitative PM. And so what we're going to do is introduce a practical framework today that helps identify how frequently it makes sense to rebalance your portfolio. So to look at some of the key drivers of rebalancing frequency, see how those impact your actual portfolio results. We're going to walk through the sensitivity of a few of those drivers. We're not going to tackle the whole thing. We're not going to boil the full ocean today, but we're going to introduce this framework that we can build on in future sessions for showing you how you can really pinpoint the ideal rebalancing frequency for your fund. So, practically speaking, like we say, this is something that very few fundamental managers really have a good grasp on. And if you were to talk to most PMs about, how often do your views change? How often do you rebalance the portfolio? You're going to get a dollar turnover driven answer. And that's a factor of them trading around positions on an asset by asset basis, selling a little bit of this, adding a little bit of that, adding a new position here and having to liquidate something there. But from a sizing and portfolio construction perspective, the best sizing decisions are made when you look at the portfolio as a whole. So when you rebalance the portfolio and when you can look at all of the different positions and manipulate accordingly to get to the risk profile and the portfolio you want. Now, so if it is necessarily something that you have to look at the whole portfolio and ideally tweak around the edges of the whole portfolio, a full rebalance gives you your best construction at a point in time. Inevitably, it's not something you're going to do every day. You're not going to, every time you trade, every time you want to add a stock, rebalance the entire portfolio and rerun and retrade every name in your book. But that drills down to really how frequently should you be doing this. And the framework we want to introduce today is to take a process that for most PMs is fundamentally fairly fuzzy and soft and make it something that's driven by key measurable items, either from you as a PM or from other parts of your organization, so that you can see how these drivers impact your portfolio's results. So how taking specific measurable inputs impacts your output so that you can make a more informed decision about how frequently you should rebalance the portfolio. Now, the reason that this is important, and the reason that honestly the pushback that we have most often with clients is people say, oh, well, I turn over my book 3 or 4 times a year. And so I think I need to run this analysis every day, or maybe I should be, running a full analysis, full portfolio construction every time I want to make a trade. And practically speaking, this analysis, running a rebalancing, running a full look at the book is going to create turnover. And so if we're rebalancing too frequently, it's going to create large amounts of excess turnover. And whether you're a manager that has turnover, where you're comfortable with 50%, or you're comfortable with 200%, or you're a really active trading long short manager and you're comfortable with turning over your book 7, 8, 9, 10 times, no matter what you're comfortable with, if you increase rebalancing the whole book, it is going to increase turnover, maybe to a degree you're not comfortable with, and it's going to impact your risk and return profile. So when we talk about this, we're going to introduce a few ways to measure the impact. So we're going to talk about how you can measure it looking at risk, return, Sharpe, but also in terms of different things you could have done. And this is a common theme if you look at our Sherpa webinars, our Sherpa process. It's important to think about portfolio construction decisions in aggregate and in averages. And it's a statistical process rather than just necessarily analyzing sort of one pinpoint set of alpha decisions. And so thinking about this, thinking about that impact in the averages helps us build this framework. And so the framework, we're going to drill it down here to, and there are more things we could add to the pie, but 4 critical drivers of ideal rebalancing frequency. So the first one is how often your views change. The second one is how much alpha do you expect to have? The third is how volatile are the assets that you trade that are in your book? And the fourth is what sort of transaction costs, what sort of trading costs do you incur by trading? And so each of these metrics is going to be unique to an individual PM. Every PM sort of has a different frequency with which they change view. Every PM has a different expectation of how much alpha, excess return, or Sharpe they have. Volatility, whether you're a sector PM, whether you're EM, whether you're developed markets, whether you trade bonds, whether you trade FX, equities, transaction costs, every one of these is something that's different PM to PM, and you have to figure out what makes sense for you. So the first kind of critical one, and this is one that we have a lot of discussion with, is that the thing you want to track here is how frequently your views change rather than sort of the turnover you're creating through trading. And this is important because the more often your views change, on paper, you would think the more you're going to benefit from rebalancing your portfolio. So if you have a portfolio where it's really long-term, buy and hold type views, then maybe your first inclination or your intuition is that you would want to rebalance that less frequently. Where if you have a portfolio where, every week, 30% of the names are in and out of the book, then that's something that to keep up with your views, you would need to rebalance the portfolio more frequently. And so this is something, when we talk about view here, again, view is not turnover, view is not your current position size, view is not, the market brought this up to be a 10 basis point larger position. View is thinking about whether it's an expected return sense or conviction or an alpha score. View is thinking about what is my view on each asset at this point in time. And so we're going to think about that in terms of the number of views that change, and sort of more importantly, how many of your views as a percentage of the total change in a given period. So do 10% of your views change in a week? Do 20% of your views change? Is it monthly or more appropriate? But in a given period, what percentage of the views in your portfolio change? So the next question, this is one that, again, I think most PMs probably have a somewhat fuzzy understanding of, and this is how much alpha do you expect to have? So if you think that you have more skill, if you think that the Sharpe of your business, if you think that your excess return is greater, essentially that means you can pay for more rebalancing, and that means you want to be more sensitive to your views. And so again, all things equal, your intuition would be that the more alpha you expect to have, the more frequently it would make sense, or the more frequently you can afford to rebalance the book. Now, the next sort of critical point, the next driver here is something that's very easy to measure, something that most PMs probably have a pretty good handle on, which is to say, how volatile are the assets you invest in? So again, for assets with higher volatility, first intuition would be that it would probably make sense to rebalance more frequently for assets that are higher vol, because you're going to see your weights deviate further from what your initial positioning was. The risk structure between the assets might change with a higher level of volatility. And so this is something you can measure simply from market price data. This doesn't need to be a complicated estimate. This doesn't need to have a lot of sort of, sophisticated modeling going into it. But to say within your benchmark, if you're benchmarked, or within your universe of assets, if you're not, and specifically within the assets in your book, how volatile are the things you invest in? And so then the fourth driver, and this one should be fairly obvious if you're thinking about rebalancing, is obviously transaction costs. The more it costs you to trade, the less trading you want to do. Transaction costs are a drag. They are a loss on your portfolio returns. And so this is a factor of many different things that are going to be very fund specific. So this is a factor of how good your trading desk is, the relationships you have with your brokers, how big your fund is. There are funds we work with that have, fairly large positions in fairly small stocks on a $3 or $4 billion fund, and trading that stock is very difficult. It's something where they really can't move around very much. And so that's a totally different ballgame from someone who trades large cap, equity long short on maybe $100 million aside, and they're a drop in the bucket. Their transaction costs are, basically whatever their trading desk or their broker says. They don't have to worry too much about market impact. And so as transaction costs increase, ideally you want to rebalance less frequently. So we're going to dive into, how this works in terms of showing impact on portfolio. And so as we usually do, Richard, let's get into the data.
Hey, thanks, Stephen. Thanks very much. So, sorry, I'm hearing an echo here. So the idea of how these four drivers impact the right choices you make, right? So these drivers are kind of extrinsic to you, or they're part of your environment, they're part of how you trade, what you do. But the actual physical decision that we're trying to optimize, to make the best decision on, is how often should you rebalance. And we're not in this webinar going to say to you, for this type of manager, you must rebalance like this. As Stephen said, it is very specific to who you are, how you trade, and what you trade. But what I want to go through now is go through a kind of framework that explains the approach by which you come out with this answer. So the framework, again, rather than being theoretical, let's just take an actual concrete example. So we're going to take a benchmark long-only EM equity portfolio. Portfolio holds roughly 40 stocks at any point in time. We don't, in this example, we're not going to look at changes in conviction. We're just going to say the view is, yes, be in this stock or be out of this stock. We making things very simple. We're not worrying too much about portfolio construction, saying everything is market cap weighted, as is the benchmark. And the active share is about 55%. So this is a reasonably standard sort of benchmark portfolio for these type of EM products. We're going to start with, let's look at our four key drivers and say, okay, let's create a portfolio that performs or that behaves in a certain way. And so roughly every week, 4 views change. So you've got a universe of a couple of hundred possible stocks. Every week you're changing views on 4 of them, which is again not unreasonable. Your Sharp, and this is benchmark relative Sharp, works out about 1.5. And the assets, well, these are EM assets, so you've got a very wide range in the volatility of the underlying, between 15 and about 100 in vol, and you've got a benchmark vol of about 25. And to start with, we're going to go, okay, what if you don't have transaction costs? And we know that's not real, but it serves to set up the framework. So the first, this picture here shows us what is the return stream that you experience as a PM or as an investor for a given set of asset selections. So we take one set of asset selections, and the selections have got alpha, and you can see that broadly the portfolio performs, and you can see that how the portfolio performs, whether you rebalance every 2 weeks, 4 weeks, 8 weeks, or 12 weeks. The left-hand side picture is the absolute returns, and I'm just showing that we're not going to look at absolute returns again, but just to show that that is the absolute returns. And you can see, you have periods when the whole market collapses, and you have periods when the market's going up. This portfolio is a benchmark relative portfolio, so we're much more interested in the right-hand side, which is the benchmark relative returns. And we're going to keep the same color code. The green line is if you rebalance every 2 weeks, blue, purple, and the red line if you rebalance every 12 weeks. And kind of unsurprisingly, right, we're having a certain amount of every week, we're getting 10% of the portfolio ideas changing. So in order to catch that, unsurprisingly, we want to rebalance more often and we get a better return. Now, that's a statement. Actually, it's not always true. This is one possible set of decisions. And with this particular set of decisions, you definitely outperform with a 2-week rather than a 12-week. However, with exactly the same background and setup, but with a different set of decisions, you can have a 12-week outperforming certainly the 4 and 8. And you can see what's gone on here. Again, it's the same market data, it's the same set of assets, same set of universe of assets, but you've selected different assets for whatever reason. And because the 12-week rebalances less frequently, you can see that on this path, on this evolution through life, you did better in the 12-week because you caught some asset that had a massive momentum drive, which in the more frequent rebalancing, you got out of, right? And similarly, you avoided the bigger drawdowns. So you can never really say on any single given path whether that gives you the right answer. All you can say is that on that path, this is the right answer, on a different path, another is the right answer. So what you really need to do is look at basically a sample of all possible paths of alpha, all possible paths that have some alpha, and say, is there a difference between when you rebalance on the 2-week, 4-week, 8-week, or 12-week? And this picture, which is very confusing, but it's got loads of different paths, and you can see that broadly, you can kind of make out that the greens tend to be going a little bit higher than the reds, right? The greens are the 2-week rebalances, and the reds are the 12-week rebalances. So the greens are a whole set of possible alpha choices that are rebalanced every 2-week, and the reds, it's the same set of alpha choices, but rebalanced every 12 weeks. And to simplify this picture a little bit, we can kind of go into it, just look at the median and the 25th and 75th percentile. And you can see, again, this is not a massive surprise, but you can see that the 2 and the 4 weeks are broadly similar. The 8 and 12 weeks are much lower. What's interesting this is that the 75th percentile of returns rebalancing every 12 weeks, which is the thin red line, I don't know if you can see my cursor here, the thin red line that goes here, is actually below the median of the 2 and 4 week rebalance. So with this particular set of assets, with their volatilities and covariance structure, and with this amount of alpha, which you kind of see roughly what it is clear that rebalancing with no transaction costs, what the impact of changing your rebalancing frequency is. And that's relatively uncontroversial, but it sets up the framework. And you can see that this bar chart just shows how the Sharp of the relative portfolio performs as you increase the distance between rebalancing, right? The Sharp comes off, and again, kind of unsurprising.
But also important. That's a pretty big difference, right? This is a decision people might not be thinking about, and that's a pretty big difference.
Yeah. Yes. Yeah. That's a yeah. That's a very fair point. It's unsurprising, but it is quite big. But it's also very specific to this particular problem set, and that's why answering this problem is quite difficult. Right? To get that data, you have to get this output. You have to really understand the input data of what is the portfolio, what is the trading style, what is the asset style. Now, what happens if we change, so that was set up with like a very simple set of drivers, right? Of how much alpha you've got, how often you rebalance, what your trading costs are, and how volatile the underlying assets are. Now let's kind of change some of those. And again, the point of this is not to get into a really full analysis, but just to show that you can build a framework which allows you to analyze the impact of changes. So transaction costs. Now this is, relatively, intuitively you're going to go, oh yeah, of course, if I increase my rebalancing frequency, I'm going to incur higher transaction costs. And if we've gone from 0 transaction costs to, and this is an EM fund, so 75 basis points, which is pretty big, but not unreasonable for 1 or 2 of these stocks. You can see what happens is that the differential between the median returns for rebalancing every 2 weeks, where you catch more alpha, and rebalancing every 12 weeks, where you miss some of the alpha, but you don't have as much costs, the differential collapses down to, broadly within the margins of error. It's kind of back to kind of 0. I mean, the 12-week is still slightly lower, but the 2, 4, and 8s are all very similar. And you can see that the Sharp, now of course the overall Sharp has decreased significantly because you've taken out, you're paying away a bunch of money, so your overall Sharp has decreased. At 75 basis points, the maximum Sharp is at the 4-week rebalance, but the differences are much, much smaller than they were when you had no transaction costs, right? So we're seeing here that introducing transaction costs reduces your overall Sharp, and it also moves the optimal rebalance frequency to a slightly lower rebalancing, but it also reduces the impact of it slightly. So those are kind of quite key points. And again, it's specific to this portfolio, which is why this analysis has to be performed for you, for your portfolio. This picture shows the same information, just in a kind of, you can see where the crossover points are as you go, as you increase the transaction costs. You can see how the returns, rather than the Sharp, of course, the returns all diminish because you're taking money out of the fund, but you can see that the rate of change changes is much less for the 12-week than it is for the 2-week. You can see where they all cross over.
And again, analyze the sensitivity for any number of rebalancing frequencies or any amount of granularity of transaction costs, which again is going to be what's appropriate PM by PM.
Exactly. It's this picture, you can't take this picture and say, oh, that applies to my fund, because there are a lot more variables in the background that are your fund specific, but it's a framework. So the other thing we can look at, when we look at how often does our view change, and how does that impact our total performance? So our original portfolio had a view change of about 10% every week. So 4 out of the 40 stocks would either go in, or 4 would go out and 4 new would come in. Here we've increased the turnover rate, so 8 out of the 40 stocks per week. And that's perhaps a little bit unrealistic in an EM fund, but it's perfectly realistic in a large cap, more liquid market fund. And you can see that as you increase the turnover of views, then the differential, clearly the more you rebalance, the more frequently you rebalance, the 2-week is clearly better, and the differential actually increases as you increase the frequency of turnover of view rather than turnover of stock, right? Because the turnover of view is the driver of the optimal rebalance, which then leads to a turnover of stock. We don't want to be focusing on what is our optimal turnover of stock. We want to be focused. Turnover of stock is an outcome of turnover of view and optimal rebalancing frequency. Right? We're not trying to solve for the outcome. We're trying to get the best overall portfolio return, portfolio outcome, which in itself you can measure the stock turnover, but it's not the driver. But of course, as you increase the frequency at which you change your view, the impact of transaction costs becomes higher. So if you remember that the graph, I'm going to do something terrible, which is this is the graph showing with a 10% view change. The differential between 2, 4, 8, and 12 weeks is, there is a differential. The 2 is steeper than the 12, but the differential in steepness is not as big. Here you can see that the differential in steepness is much, much bigger, right? We're changing more frequently, and therefore increasing transaction costs has an even bigger impact. And again, that's not counterintuitive in any sense, the direction, but the scale and the fact that these lines are that much steeper than they were with the 10% rebalance may well be counterintuitive. And that's the important thing to have in your head. So if we go the opposite direction and we say, actually, rather than 4, we just go 2 views a week change, 2 asset views a week change, then we see actually, first up, a much bigger impact on rebalancing. So if you remember the previous picture that showed the sharp by rebalancing frequency, the bars were much closer together. Here, with a more slow view change, the impact of rebalancing even more slowly is much bigger. Right? You do much better to rebalance more frequently because you will catch all the view changes. Right? There aren't as many view changes, so if you wait a long time between rebalances, you're going to miss a whole bunch of, you're going to miss a larger proportion of the total number of changes that happened in the intervening period. And that's what
you tend to see, that big spread as one asset grows. And
because you've missed a whole bunch of stuff. You've missed a much bigger proportion of the alpha that you're generating. That's that part. But of course, transaction costs have a lower impact. Now that's quite interesting, right? Frequency has a bigger impact, but transaction costs have a lower impact. It doesn't change no matter what the transaction costs. You can see the highlighted row is always at the 2-week rebalance. Really, no matter how much transaction costs you have, if your view is changing that much more slowly in this portfolio with this set of assets, you are still better to rebalance more frequently. So that may be slightly counterintuitive to you, right? My view is changing more slowly, so I should rebalance more frequently. But it's clearly what's happening. Now, this is, and I'm just conscious of time here, this is a quite a simplified example, right? We kind of over-exaggerated transaction costs, and we talked about portfolio rebalances rather than individual trade rebalances, and we're only looking at 2 of the 4 drivers, right? We didn't really look at the volatility of the assets and the quality of your alpha, which both also impact. And I think it's pretty fair to say that most of you will have an intuitive idea of the direction of the slope of any one of these lines. But the way that the lines interact, and for instance, the fact that lower frequency of view change should lead to higher frequency of rebalancing may be counterintuitive, and actually is extremely important in achieving marginal gains in the overall final portfolio result. And that's where I kind of want to, again, this webinar is not the place to do it, but we talk about the Sherpa rebalancing framework, right? A full framework for analyzing, given any specific portfolio, asset set, manager style, alpha style, frequency of view, all this sort of thing. For that specific problem set, what is the right outcome and what is the sensitivities to those outcomes. So again, without going into any detail, I just wanted to kind of raise the idea for everyone that if you have a portfolio and you clearly you know, or we can certainly help you understand what is the way your portfolio acts, how many assets you've got, how do you generate your alpha, how do you define that portfolio, and broadly the things that are in the yellow block here on the sort of rebalancing framework thing. For a given portfolio, we can say to you, okay, given all this, this is what the optimal rebalancing frequency is, and what is the impact of doubling or halving that frequency. And again, all we've talked about today is really return and Sharpe in quite loose terms. What you're really interested in is not just return and Sharpe or volatility, but also what's the impact on overall drawdown, what's the impact on transaction costs. You may want to know what the impact is on things like specificity of risk. So clearly, if you rebalance, if you are driven by your LPs to have a very high specific risk content, the longer time you have between rebalances, the bigger the opportunity is for risk to change, and therefore break mandate's a strong word, but to get your LPs might be more uncomfortable because your risk has changed in that period of time. So a full rebalancing framework, like the Sherpa rebalancing framework, answers the question for my portfolio, for the way I trade, and the way that my assets act. First up, what is the optimal rebalancing frequency? What is the sensitivity to that frequency of the various metrics that I care about? And providing that answer it's not a trivial thing, and it requires quite a lot of back and forth. But once we get the information, we can model up the portfolio and the PM behavior and the way the analysis operates, we can give you this information, which I think is extremely valuable in, again, doing what Sherpa does best, which is marginal improvement of performance through process.
It's really about quantifying trade-off, quantifying how the different drivers work and how they impact the different things that you care about in your portfolio, so that you can make that more informed decision about how often you should be thinking about the full portfolio, how often you should think about individual trades. This gives you a more robust process, and it gives you more information to speak to your investors, your boss, whomever it might be, about why you are making the decisions you are making, so that you can explain and illustrate why your process works the way it works, why you would expect it to work, and what the drivers are that you actually understand how those interplay. And so this is a framework for quantifying a lot of things that, again, PMs might have intuitive thoughts about, but fundamentally it's a fairly fuzzy understanding, and this allows you to really help quantify and better understand how those different parts interact in your portfolio.
Yeah, and as you said, Stephen, how to explain it, right? How to explain it, and how to tell the interested parties, your LPs, your bosses, your colleagues, that yes, I have a process for this, and these are the drivers, and this is the analysis that led me to those processes.
Right. And so, really, again, like Richard said, this is the purpose of today's session was to introduce this framework. So in a future session, we're going to dive into more of this, because this is a topic that, again, we think is fairly important. And it's a topic that we talk to clients about. And the number of clients who, for different reasons, bandwidth, commercials, their perception, their current turnover number, whatever, have fairly strong but fairly unfounded opinions about how often this should be done, is what's inspired us to continue building out this process. So in the future, we're going to dive into this in more detail. We'll look at more metrics of impact. We'll see how we can look at those different interrelations. But today we wanted to introduce these critical drivers, thinking about the Sherpa rebalancing framework, and thinking, for you as a fund manager, just being sure that you think about using a objective, quantifiable framework for making these decisions. So if you want to know more about how we do this, rebalancing framework, portfolio construction, otherwise, if you have any questions, if you want the slides for today's session, contact information is here on the slide. So feel free, get in touch. We'd love to help you build a better portfolio and a better process for portfolio construction. So we've gone a little bit over time, and I don't see any questions, so I'm not going to necessarily pad out our time. Richard, thanks so much for taking the time today. Any last comments?
No, thank you all for attending. I hope this was informative for you. Stephen, thank you very much for, as always, putting us together and hosting us so elegantly.
Always my pleasure. So again, if you have come in late, feel free to email. The video will be on the Sherpa Funds Technology Process Alpha YouTube channel later today, and we hope you can join us next time.
Thanks very much. Bye-bye.